So these are the regulators. These are the people who regulate. Now, because the money is taken by the companies, and company can put that money for doing business, or they can even do some kind of a fraud. Like we came to know about this Blue Smart. There was a taxi operator. Which have you read about that? Any one of you? So yeah, Jaggi brothers. Okay. So, they have actually raised a lot of money, and then the money was spent not only for buying, the new cars, but they have been bought for personal this thing also. So that's why, all these, kind of issues which, people are raising money either by way of debt or by way of equity. So this needs to be regulated. Now, again, in this case, Jaggi brother, who was the person who first noticed this kind of a fraud? SEBI, isn't it? Yeah, so it is the SEBI which came to know about this, which has happened. Okay, because so we'll understand what are the kind of regulations which the SEBI or the Companies Act or the stock exchanges or the Reserve Bank of India, these are the regulators. Basically, they have framed lot of law so that the companies can't do any fraud. Now, frauds can be always done. Okay, but the idea is that the people should they should follow all the norms and regulations. So there's a very less chance of anybody committing a fraud or such kind of an event. But still, people are such, they can find always loopholes and I mean siphon away a lot of money of the public. So let's understand. Okay. So these are the various, like we have Companies Act, we have the stock exchanges. We have two major stock exchanges, Bombay Stock Exchange and a National Stock Exchange. Then we have the Reserve Bank of India. So these are the regulators of public issue. Now, what are the key regulations? Can you read, Akriti? Now, these are the three kinds of, regulations which governs the raising of money from the public. The first one is called the SEBI ICDR, Issue of Capital and Disclosure Requirements, which was, originally started way back in 2000. Then now it has become 2000 after a lot of amendments which has taken place, and it's called now SEBI ICDR regulations. So most of the time we'll be focusing and understanding what are the rules and regulations which has been put by SEBI under this regulations. Then we have the SEBI listing obligations. No, we all know that companies, once they issue shares, they need to be listed on either Bombay Stock Exchange or National Stock Exchange. Okay, so they need to follow certain norms of listing. Okay, they have to do a lot of disclosures. So every quarterly they are supposed to declare their performance, like how much money, how much profit they have made. They have to publish their balance sheets and everything. So these are all contained under basically the LODR. So there are two kinds of regulation. One is called the ICDR, another is called the LODR. Okay. So the third one is called the Companies Act 2013. Just a sec, I'm just coming in a half a minute, okay? Okay, I'm back. So these are the three regulations, okay? And we'll be talking about ICDR most of the time, and then we'll also cover LODR at a later part of our this thing. So these are the regulations, okay? ICDR, LODR, and the Companies Act. Okay, so these are very interesting regulations, and you will, as we cover all these regulations, you will understand these, and they are very simple to understand also. Okay, so the first one is called the SEBI Issue of Capital and Disclosure Requirements, Regulation 2018. Now, the knowledge of these regulations are very, very important. Okay, whenever there's an IPO or an FPO in any company and you have a good knowledge about these laws, then you can be, part of this whole process of raising IPOs. When I was working in a company called Idea Cellular, so we came with an IPO in 2007, and I was involved in the whole process of how the money is going to be raised, how the company is going to do an IPO. So if you have a knowledge about these regulations, so it will help you. Okay, so at that time I never had any knowledge about these regulations. Okay, so the knowledge is very, it's a very prime knowledge, and you must have it. Okay, so let's understand. Just read this, Akriti. Now, I'm just covering briefly, what all we'll be covering under these regulations, okay? And we'll find so many boxes which will be coming in my further slides. So here I won't be talking much, but I'll be telling these are the things which we'll be covering, okay? Like what are the types of issues? So we'll be focusing mainly on an IPO or an FPO. Okay, so what are the regulations with respect to IPO and FPO? Of course, the regulations can be for bonus shares or for rights issue, for other things, but mainly we'll be talking about an IPO and FPO. Of course, for understanding about the requirements of a rights issue or a bonus issue or any other kinds of issue, you can always refer to these regulations. So I'll be sharing these regulations also with you. Okay, it's a pretty long, it's about 500 pages regulation, and it's impossible to cover everything in these lectures. Then we talk about eligibility requirement. Now, what are the companies who are the companies who are eligible? Who can come and raise money through a process of an IPO? All the companies, they can't raise money, by asking people or public to give money. So there are certain requirements by SEBI, okay, and it's called eligibility requirements. Similarly, there are eligibility requirements for an FPO. That means that the company has already done an IPO and it wants to subsequently raise money. So these eligibility requirements are contained under FPO. Okay. Then additional requirements for offer for sale. Now, sometimes the existing shareholders would like to offload their shares. Either they can be promoters or they can be very big investors, okay, which have already invested at a time when the company was young and small. So now they are trying to, encash their, money, whatever they have put. So they want to have a good return. So they would like to offer their shares, okay. And so there are some additional requirements for that given under the ICDR regulation. So we'll cover in there. The issue of warrants. Now, warrants are basically, attached to the IPO or an FPO. They are instruments which gives you a right to, just read this last paragraph, Akriti. Okay, now issue of warrants is basically it's a financial instrument. It is issued by the company at the time of a IPO or an FPO, so that it gives you a further right to buy equity shares at after some time. Okay, and the price is fixed at that time. So basically, this is to attract the investors. That of course, if you go for an IPO, then you will also have a subsequent right to go for further buying of shares, where the share price is fixed and in advance. Okay, at a predetermined price, and the money you will going to get after the shares you are going to get after certain time. So these are called issue of warrant. Normally, I'm not going to cover everything. Okay, I'm just because the warrants is something new, so that's why I'm talking about at this point of time. But we'll be covering about issue of warrants subsequently. Okay, fine, in detail. Okay, that was just a kind of a little understanding about what are warrants. Now, warrants are basically nothing but financial instruments which are attached to the IPO or FPO or any kind of a issue which the company is going to come. So that time they can offer shares also. Subsequently, also the company says that you can apply for shares at a certain price. Okay. So then we have filing of offer document. Now, whenever a company wants to raise money, they have to make an offer document, which is called prospectus. Have you heard about prospectus, Akriti? Acha, no, acha, no, this is a very, very important, whenever the IPO comes. So, there is some document which is called prospectus, very popularly called prospectus, which is at this time it is called offer document, because it will be only after the SEBI has, given its full, nod or given a permission for a company to raise money and given okay, then it becomes a prospectus. Then that prospectus can be circulated among people so that they can read and then they can, go for, buying the shares of that company. So a prospectus will cover all the details about the company, who owns it, what kind of have been their past performance, and what, how much money they are going to raise, and where your money is going to be, spent, how they are going to, expand the companies. Like, when I was working with the idea in 2007, so we came with an IPO for the first time. Company was becoming public. So at that time, our purpose was to become a pan-India player. So that time we were present only in 6 cities or 6 major towns of India. So we wanted to be in all, 26 kind of cities or towns or states in India. So actually we call them circles. So we were present only in 6 circles, and we wanted to be having a pan-India presence. So we wanted to grow and expand and provide our mobile services all across India. So we needed money. So that's why we had floated a prospectus. At that time, when you raise the prospectus, at this time you file an offer document. With whom? With SEBI, for obtaining their approval. So it's called filing of offer document. Okay. It will contain about the details of the company, and for what purpose the company is raising money and how it is going to spend. It is giving to give you full details at what price the shares will be issued to the public. So it gives you a full detail. First is filed with whom? SEBI. SEBI gives the approval, then it becomes a prospectus later on. Is that clear? Akriti and Ritesh? Okay. Then, yeah. So then draft offer document to public. That means at the same time when the offer document is given to SEBI for the approval, it must be, circulated to the public also through the website of the company. So that if the public, they can read it before, even applying for the shares, before it becomes even a prospectus. So if any public or any person has yeah, if any person has any kind of a, they want to ask anything from the company, so they can, always seek some further clarifications. So this is just a draft offer where it is, shared with the public. Okay. Then we have ASBA and UPI. Just read this, Akriti. Okay. Now, what happens is when you're giving money to when you're applying for an IPO, so earlier we used to have ASBA. Now we have UPI. Okay. But today also we have ASBA and UPI both function at the same time. Long back we used to give our checks. Okay. Whenever I'm applying for shares about, 10-year back or 15-year back, when there were no ASBA or UPI, we used to give a check to the company. Company will encash that money. Okay. Keep it in the bank account. And then, when the company receives all those applications, they'll find that they have received 10 times more money than what they need. So they need to refund all the money back to the applicants. Okay. So sometimes the money was not returned. Either the money was, the checks were misplaced in the post, or, some problem. So, you'll always be looking that your money has not come. Either you have not received the shares, or you have not got your money because the shares were not allotted to you. So there's a lot of issues. So then came ASBA, where you give the money, you give a mandate. Okay, what is ASBA? Let's see. Just read at the bottom. So that means you are actually making a payment through ASBA, where your money will remain in your bank account, okay, blocked. Now you can't use that money for your own cash withdrawal or for doing any other work. So that money will remain with the bank in your account, unless the company says, okay, if your shares are allotted to you, they will take out the money from your bank account. It will go to the company's account. Otherwise, they will remove the block. If suppose the company receives 10 times more than, the applications, so they have to refund all the money. So here they will just, that time the block will be removed if you have not got the shares you wanted. But if you have got the shares, that means the company has already allotted the shares. The money will move from your account to the company's account. Okay. So similarly, UPI is also a similar kind of this thing. So here also the similar mechanism takes place, that it is much faster than ASBA. Okay. UPI, as we know, it's all basically all digital, kind of this thing. So it is much faster than ASBA. So here also your money will remain blocked. Okay. till the shares are allotted or not allotted to you. Okay, is that okay? Have you got it? Any questions? So, whenever you are making an application for a new shares in a company through a process of IPO, you can use now UPI. Earlier, about a year back, it was ASBA. Now it's UPI. It's a new form of ASBA. And UPI, the money is not going directly, immediately from your bank account. It will remain in your bank till the company gives, if the shares are allotted to you, then the money will be taken out from your bank account. Otherwise, the blocking will be undone and the money will be become free to you. Okay. Then we have security deposit. Okay. So, whenever the company is raising money through the stock exchange, okay, for the, by raising the money through an IPO and FPO, so they need to deposit 1% security deposit of the issue size with the stock exchange. Okay. That means if the company is coming with a 100 crores of an IPO, so they need to deposit 1 crore with stock exchange as a security deposit. And the money will remain with the stock exchange till all the formalities and everything is done. Then this money will come back to the company. Is that okay? So why the company earlier this security deposit was not there, but now it has come into because a lot of companies they are raising money and some companies are not very serious about it. So this was to add seriousness, because there's a lot of whole process where a lot of time of both stock exchange as well as SEBI everybody is required. So company must deposit some money with either stock exchange so that then they become serious that their money is at stake. Okay, they'll get this money after they have fulfilled all the norms. Then we have opening of issue. Once the SEBI has actually given okay to your of a document, it says it's fine. Okay, then it becomes a prospectus. Okay, you file it with the register of companies, and now you can go for opening of the issue. That means you can say now we can take money from the public. Okay, so you'll announce a date on which your IPO will open. So that is called opening of an issue. Then underwriting. Now, the merchant bankers, we now the merchant bankers come into play. So, whole of this process of raising money through ICDR is always assisted by merchant bankers. So they are always helping the companies to raise money, and they always, some of the merchant bankers they act as underwriters. Okay, like the companies can go and can get their shares underwritten, the IPO and FPO. Basically, the shareholders will get a kind of a confidence that in case if the share issue is not true, if there is not enough response, then the merchant bankers have to take the shares of the company. So all the shares will devolve on the merchant bankers. Okay. So merchant bankers acting as a guarantor that in case if the public doesn't take money, we will take, you will become your shareholders. So this gives a confidence to the shareholders that there is a big merchant banker who is taking the responsibility in the event of the IPO not going through. Okay, so they are underwriters, so they charge some commission for that. Okay, so we'll understand more because this is just a prelim stage. We are not covering what is underwriting. We'll be going it more in detail as we go through. Minimum subscription, 90% of the issue size. That means if suppose the company is raising money for say 100 crores, at least 90 crores they should get money from the public through a process of IPO or FPO. If they don't get, they have to return the money back to the applicants. So what is the minimum public subscription? 90%. So that means the shareholders, the new applicants, sorry, not the shareholders, but the applicants who are giving money, they should actually give at least 90% the issue size, so that the company can allot shares to them. Otherwise, the company has to return the money back to the applicants. Then, at times what happens, there is always a oversubscription. Have you heard the word oversubscription, Ritesh, Akriti, or Abdul? So oversubscription means that you require 100 crores, but you got 1,000 crores through the process of IPO. So this is called oversubscription. Now, what you will be doing with oversubscription? You have to return all the money back more than the money which you have received. Suppose the IPO size was 100 crores and you have received 1,000 crores, so that means you have returned how much? 900 crores. But there are rules and regulations. So in how much time frame you have to this thing? Can you retain some part of oversubscription? So we'll understand those rules. Okay. Then monitoring agency. See, when you raise money through public, from the public, then the SEBI appoints a monitoring agency which will check whether the company who has raised money, they have deployed the money for the purpose for which the IPO was there. Now, because if the IPO says that we are going to raise this money for buying, for doubling our capacity, for buying new plant and machines, equipments, so whether you have bought those plant and equipment machines or not, so the monitoring agency is going to audit your accounts and they will submit the report to SEBI. Similarly, suppose the company says that we are going to pay all our existing loans, okay, which we have taken to the bank, because the company may be having, raising a IPO for say 1,000 crores, and the company already has 1,000 crores of a loan. So the company may say that we are going to pay back all the 1,000 crores to the bank. So whether the company has paid all the money or not, or their debt has become zero or not, or to whatever extent they have said in their prospectus. So have their, so the monitoring agency is going to check. Okay, and who are the monitoring agencies? All the credit rating agencies, all the credit rating agencies like ICRA, all these companies now act as a monitoring agencies. Okay, fine. Crisil, ICRA, and many companies like in India who are the credit rating agencies, they will act as a monitoring agencies. Then allotment procedure and basis. So another 10 minutes, then we have a break. Allotment procedure and basis. How the shares are going to be allotted. Okay. And what is going to be the basis of allotment. So we are going to understand that. Then refund and interest. In case if the money has to be refunded, how much interest needs to be paid back. So that is to be the release of subscription money. Okay. Now, whenever the company raises money through a process, an IPO and an FPO, the money goes into an escrow account. It will never go to money will never go to the account of the company. It will go to an escrow account. Once the company has raised all the money and done all the formalities, and the merchant bankers gives a certificate to SEBI that all the formalities has been done, then the money will move from the escrow account to the main account of the company. Okay, so this is called release of subscription money. So what is release of subscription money, Akriti? Okay. Absolutely, absolutely. Then the company can spend that money for whatever purpose they want, what they have mentioned in the IPO. Okay, so this is what they okay. Then we have a price and yeah. Why it is required is that suppose, like if you see there was an issue of Adani which came, quite a year back or so. So, they have received the money and all the money was lying in the escrow account. Now, the Adani could not, the issue could not get through because, there were some kind of an allegations or, or there were certain, things, which the company could not complete. So, as per the SEBI, so money has to be refunded back. So if the money goes to the company's account directly, so there is always a chance of a fraud or something. So that's why the money should be first parked in a account, intermediate account, which is called the escrow account, where the company cannot withdraw any money till the merchant bankers gives a certificate, and the banks, get those certificates, and then the bank will release that money to the company so that they can use it for the purpose of their business. So this is basically an extra security layer, okay, to see that all the regulations of SEBI are met with before the money can be used by the company. Is that okay, Abdul? Okay. Then we have price and price band. Whenever the companies are issuing shares, they have to decide at what price they are going to issue the shares at. Okay, so every company decides about the price, whether it's at 10 rupees shares they are going to issue at say 100 rupees. Like when Idea came and issued shares, 10 rupees shares were issued at say 70 rupees. 10 rupees of 70 to 60 rupees of premium and 10 rupees face value. So companies are going to decide about the price. Now, instead of deciding a fixed price, they can always say a price band, like shares between, say, 100 to 120. Okay. So this is the price band. Now, all the investors, they can make a bids, that is called the book building process. So we are going to understand in a book building mechanism, there's a price band which is fixed. Now, all the shareholders, they will do a kind of a, they will bid for the shares. Okay. Is that clear to you, Akriti or Ritik, Ritesh? Okay, so I'll just show you, before we go to, we'll just have a break after 5 minutes. So I'm just going to show you how this mechanism works. Okay, little bit before we really understand this, there's something called book building mechanism. Okay, fine. Where, instead of, a kind of a, uh, there is always a price band which is fixed by the company. Okay, fine. So just read this. Okay, hold on. Now, a company can always, issue shares through a book building mechanism. Okay. Or it can even shares issue at a fixed price that they can say that, okay, we are going to issue shares at say 1,000 rupees. Okay. No price band. So there's always a choice of the company. But we'll understand, of more about that in detail in my coming slides. So which companies have to go for book building mechanism always? Okay. Some companies can go for a fixed price mechanism also. So the price band is between 1,000 to 1,200. Now the price band has to be between, there should be a 20% gap maximum. Okay. Like, if it is 1,000 here, okay. So if we add 20% to this, okay, and add this up here, so this is the price band which is permitted. That means this is called the upper limit. So this is the upper band. Okay. Or sorry, this is called the floor and this is called the cap. So all the price band will have a floor and a cap. Okay. If the company is issuing shares, so they have to say what is my floor price and what is my cap price. And the difference cannot exceed 20%. So it can't be like 30%. Okay. So this price band will not be acceptable. So price band has to be, there should be only 20% difference maximum. Okay. Sorry. Fine. Is that okay? Now the law says, the recent amendment which has come, the minimum price difference should be 5%. That means the price band can be between 1,000 and 1,050. So this is also permitted. But company cannot have this price band 1,000 to 1,010. Okay. So there is a minimum, price band should be max, difference should be between the floor and cap should be, minimum should be 5%. Okay. Fine. Okay. Maximum is 20%. Okay, this is the maximum and this is the minimum. Okay, so let's understand, then you will understand. Okay, suppose now these are the bids have been now received. Start from this, bid have been received from various investors. Read this again. Akriti, read. Now, yeah, determine the cutoff price and identify the selected investors. Okay, so basically now the company wants to issue how many shares and how much company has received applications. So let's, total it up and see how many shares they have got, how many bids they have got for how many shares, and how much, if you look at this column, where my cursor is, how many, number of shares, 8,000. Okay. So that means we have to determine the cutoff price. At what price the company is going to, issue the shares, at what price they are going to issue, and who are the investors who are going to get the shares. Okay. So the first question is we have to decide what is the issue price. Okay. So in a book building mechanism, the issue price is not given. It is only the price band which is given, and we have to determine the issue price. So that is called the cutoff price. Okay. And then who are the shareholders who will get the shares of the company and who will not. Okay. So first what we are going to do is we are going to organize the bids in descending order of the price band. So that means you have to put the first one will come 1200 air. So now this is in the price, this thing. Okay. So if you look, there was a person who has investor D had applied for 1500 shares at 1200 rupees bid price. So this was the maximum bid price. What is the next maximum? Ritesh, Abdul, 1190, isn't it? 1000 shares. So if I just put here all these shares, okay, number of 1290, 1190, 1180, okay, and then I make a cumulative of that. Cumulative. I'm going to share this Excel sheet very shortly with you. So this is, that means 1500 shares, price was 1200, cumulative 1500. Then 1000 more, so cumulative the bid price is 90. So here, investor B, he has applied for 500 shares. What is the bid price? 11. And how many shares? 5,400. So what will happen will be the cutoff price will be 1105, because at this price, all the shares, company required, they have got the full money, a full number of shares, 5,000 shares which the company wanted to issue. So all the shares have been can be allotted. So then what will happen will be identify the cutoff price. Read this uh, cutoff price. Yeah. Okay. Okay, so these are the people who will be getting shares now. All others shareholders will be returned back their money. Either their ASBA account or UP account will be deblocked. Okay, and these people will be given the shares of the company based on the book building mechanism. Is it clear to everyone? Okay, so we'll talk about more about book building later on. So this was just a kind of a first, understanding about that. Okay, so now we are going to have a break. Okay, and let me just. Okay, so what's the time now? It's 3 o'clock. So 3:20 is okay. 3:25. Okay, in between 3:20 to 3:25, we'll meet again. Okay. Have you followed what we have done so far? ओके ठीक है अब 320 325 के बीच में मिलते हैं ओके